Good morning, everybody, and a very warm welcome to Where Will the Money Be Made webinar from Anchor. Hope you're having a great day. It's wonderful to see you all. I am Neil Brown, the head of Anchor Asset Management, and what I'll be doing today is just doing a brief introduction to give you an update on the business, and then I'll move on and hand you over to Nolan Barpana, our co-CIO and head of fixed income, who will talk to you about the fixed income side of things in asset allocation, followed by Peter Armitage, Nick, Liam, and Henry, who will cover local and global equities. We'll take questions at the end, and please post your questions as we go along. We'll monitor them, I'll collate them, and we'll answer most of them at the end. We may answer a few during the session, so watch the Q&A box, but we'll leave most of them to the end. The format is pretty much the same as we've had before, in which we take you through the key themes that we believe are affecting local and global markets, unpack our understanding and share our views of those key themes and factors with you, and then ultimately distill that into an investment view and show you how we're thinking about where the opportunities lie and how you should avoid the current risks that are out there at the moment. Before I go to the business and give you an update on how we've done as a business, just to take you back in time to February this year, before the whole world kind of changed for everybody. Just a reminder of what we were saying at that point in time. At that point in time, the rand was at 15 rand to the dollar. Our views were, I guess, relatively benign on the local front. We found both fixed income and equities to be relatively attractive, although we were concerned about the sort of risks out there, and obviously the reform agenda was important, but we had relatively benign views on both of those. Globally, we were less inclined to favor global fixed income. Our preferred asset class was equity, but we were a bit worried about valuations at that point in time, which led to an asset allocation, which you see in front of you, where effectively we were positive on bonds and cash on the local side, negative on bonds and corporate credits on the global side, and then pretty much neutral on everything else. Then, of course, the whole world changed, and we all became Prumers, or professional Zoomers. We all had to be sent home very quickly, and all had to kind of behave ourselves and not have access to alcohol or cigarettes or any of those naughty things. Obviously, it's been a big change and a massive change, and we've all I've lived through it and are currently living through it, and I'm not going to belabor the point really. I just want to give you a bit of insight in terms of how we as a business reacted to it and how we've done over the last 6 months or so. And for us, really, I guess there were two major things. The first thing was to make sure that our people were safe and comfortable and enabled to carry on working and doing what they need to do. And then secondly, to do exactly that, for us to carry on, doing our best and applying ourselves to produce great outcomes, to improve what we do, and ultimately to grow the business and improve our business, and, as I said, produce great outcomes for clients. So I just want to cover a little bit of that and show you some numbers and some figures in terms of how that has all transpired. So firstly, we can start off on the left-hand side. Remarkably and very gratefully, our business has actually grown over this period. We started the year at about 22 billion under management. That's up about 5%. To 23.1 at the end of June. Obviously, we experienced the sort of V-shape. Things weren't looking as rosy at the sort of end of March, but thankfully markets have come back. But on top of that, we have enjoyed flows. The flows have pretty much followed what's happened in the general market. We've enjoyed flows into the fixed income side of our business, as well as on the global equity side, and specifically global tech has also enjoyed some good flows, where the other asset classes, the local equity side of things, the multi-strategy and the hedge, the story has not been one of inflows. In fact, slight sort of outflows mirroring the market. But, very thankfully, I think off the back of some good performance, we've had some good flows, and our business has actually got bigger over this period of time, which is great. Unfortunately, the numbers only go to June. Given that we are listed, I can't share with you more, but subsequent to June, we have also enjoyed more flow. So that's great, and thank you very much to those of you that have supported us. Our business is all about people, and from a people perspective, as I said, our main focus as we went into the sort of Corona chaos was to make sure that our people were looked after, and I'm very happy to report that we've come through that very nicely. No team changes. In fact, I think this period has actually enabled us to solidify some of our processes and the way that we do things, and I think our team is as strong and as gelled as ever. That growth and has also led to some new product developments. We're not a product factory. We don't spit out products every month. But in order to meet demands and needs and to grow our product set to sort of cover all the bases, we have added 2 new funds, which you'll see there, and a BCI Core Income Fund and a Global Flexible Income Fund. I won't spend a lot of time talking about that. Nolan can cover that in his section, but those are sort of, I guess, will complete our fixed income product set. Then ultimately, what we do and what we produce are investment outcomes, and that's why people invest with us. And obviously, we hope to be world class and produce good, solid returns over time. We won't be on top of the pops every single day, month or week. So we do obviously have a look and evaluate how we're doing over time. What I've got here, we have a broader list of solutions, including segregated mandates, but the easiest thing to compare it to are sort of looking at the local CISs. So I've got a list of 9 of our local CISs here, which basically cover the various asset classes and cover where most of the money really is invested in terms of the local CISs. So the first point to point out is many of our funds are now getting decent track records. Our oldest funds are over 7 years old. 4 of the 9 funds are over 5 years old. 4 of the 9 funds are over 3. And there's one sort of a newbie on the block, which is the Global Technology Fund. You'll see there's a lot of columns on this sort of slide, and I'm going to have to show you all of the detail because that's what we need to do from a regulatory perspective, but I'm certainly not going to drag you through all of it. So here's the slide with all the gory detail, and we will distribute it afterwards so you can have a look at it. But what I really want to zoom in on is this. Ultimately, we would like to produce good returns from an absolute perspective. That's not always possible depending on situation, asset class, and certainly has been a challenge of late. But obviously one of the ways that we do look at things on a relative basis by comparing how we rank relative to our competitors in each of the different categories. And what I basically got here is just a summary of how we've done since inception for the various funds I have on the screen. And you'll see, very pleasingly, majority of the funds are in the first or second quartile. The only one that's not is the managed fund. And if you look at the sort of funds that are in the top quartile, you see they're also towards the top of the class as well. So very pleasing performance. A little bit naughty, I suppose, to put the Anchor BCI Africa Flexible Income Fund in the top quartile because it's also in the second quartile, the third quartile, and the fourth quartile because it's the only fund in that category. But I think that speaks to our ability to create some unique solutions as well that provide a differentiated offering for clients who are looking for that. So I hope that gives you a sense of how we've done. We're very thankful and grateful that we live operate in the industry and have been able to navigate this very difficult time well and hopefully emerge not only having survived but having thrived and having become a better business. So without further ado, I'd now like to hand you over to Nolan.
Good morning. Frantically clicking on buttons here to get started. Thank you very much for dialing in to our roadshow. Bear with me. My previous computer sort of logged me off in the middle of a webinar last time I used it. So I've switched computers and buttons have moved to different places, but we'll work through this. I've been asked to share a video. We're going to switch that off. So hopefully right now what you've got is a screen which says fixed income. I think my video is switched off. I'll turn it on in a few minutes. But very much I'm going to talk you for the next 20 minutes through our asset allocation views firstly, and secondly through our fixed income views, and then I'll hand over to Pete. As Neil said in the beginning, please type in questions for Q&A. The truth is we'll only talk about those a little bit later. But for now, let's work through this. So in terms of fixed income and asset allocation, the starting point is that the starting point for any fixed income discussion these days is what about South Africa? Because South Africa as a country is basically running out of money, or certainly our government is running out of money. And it's probably the number one question I get asked is, what is the direction of South Africa, and how can I invest in bonds in a country that's in our fiscal situation. So I'm going to talk a little bit through South Africa and sort of talk about how we think about it in Anchor, and then from that we can talk about what that means for asset allocation. But in terms of South Africa, what we see is, I've got it outlined as scenarios, but it's almost like a continuum if you want. And on the one side is the high road. It's the scenario where everything works, we get economic growth going, prosperity follows. On the far opposite end of the spectrum is effectively a failed state. The government runs out of money and we go Zimbabwe, Venezuela, or sort of pick your sort of country, I guess. But those are kind of the two extremes. In between this, though, because it is a continuum, you have other scenarios that we've got to be aware of because there are realistic possible outcomes, and South Africa can move between different sort of points on this continuum over time. And the first is what I've dubbed a road to nowhere. And this is a situation that will arise if South Africa is able, to kind of get enough revenue going, reduce its national expenditure, get the economy growing slowly, and we find ourselves in a country where it just bumbles along. It doesn't really get any better. It doesn't really get any worse. This is a very plausible scenario. And in fact, many African countries have sort of found themselves in this situation. And I talk primarily East Africa. It's a sort of Kenyan, Tanzanian type scenario of an economy that just bumbles along and the status quo is maintained. The other scenario we've got to be aware of is one where we bumble along, but the government expenditure eventually exceeds revenue, and the government is forced into a sort of bailout, into approaching agencies for help. And at that point in time, the help typically comes in the form of financial assistance along with policy corrections. Commonly dubbed the IMF, not that the IMF is the only bailout institution. The Chinese might help, the Russians could get involved. There are a number of different combinations. However, we've got to, from my perspective, what we're saying is there is a chance of a bailout type scenario that we can't take off the table. So those are really the sort of scenarios that we think about here at Anchor. In that regard, for each of the scenarios, they've got different watch points. For the high road, what do we really want to see? We need to see that the government regains the trust of the population. It regains the trust of the private sector for private sector investment and private sector growth. We need to see pro-growth policies, and we need to see SAE reform. No surprises. But the road to nowhere, the sort of bumble along scenario, what you really see is that the developmental state ideals trump reality. What that means is that the idea that the government can drive economic growth, that the government should drive investment continues. We see that government expenditure comes under control to a degree sufficient to allow them to just maintain the status quo. And to do that, we need to see slowed corruption. For the bailout scenario to then come into effect, if we look at a slightly worse outcome, what you see is over time, it's relatively stable, but state-owned enterprises, SAA is a prime example, and grants to the unemployed drain the fiscus. We see a lot of comments on UIF at the moment where the government's saying, look, it's not an infinite pot of money. We talk about corruption that then remains endemic. So basically, the corruption means that the theft from the government is at such a pace that we can't afford it. And ultimately, when the government runs out of money, it needs to make a decision to go and seek a bailout. So that's what we look for as watch points for that scenario. The final scenario is a failed state, and this is typically going to take place where populist solutions take preference in the government's eyes rather than looking for help. We talk about solutions like printing money, QE to finance the government. Not a great idea. The Turkish tried it recently. We talk about taking money from pension funds, prescribed assets. I can't think of a single regime that's actually instituted prescribed assets and survived. It tends to be the sort of last gasp for cash for a government. And similarly, we talk about a default on the nation's debt, which again would ultimately lead to a failed state. So those are the scenarios. That's how we think about them. And, those are some of the key watch points. What is interesting for those, though, is that for each scenario, they have vastly different asset allocation requirements. And that's what makes asset management and asset allocation challenging at the moment. All of those scenarios are plausible, and we've got to try and find an asset allocation that actually, suits most of them. So in the high road scenario where South Africa's economy takes off, no surprise, you want to buy South African risk assets, South African equities, South African bonds, and you want to reduce your offshore exposure, and you want to reduce multi-asset income, your stable funds. In your road to nowhere scenario, and actually in your bailout scenario as well, what you will find is that you want to buy African income, so you want to buy South African multi-asset income funds, you want to buy bonds, but for your growth assets, you want to look abroad, so you want to buy offshore equity. And that's what the asset allocation becomes in those sorts of scenarios. And then finally, in a failed state, you basically sell everything in South Africa and you buy everything offshore. So that's the sort of fourth scenario asset allocation that we're dealing with. And different people, when we speak to them, actually have different perspectives of where we are and therefore different asset allocation requirements. From our side, trying to look at this impartially, let's look at what's happening in South Africa at the moment. So in terms of pointers for the high road, what makes us think that the high road is possible? We have seen tenders recently for 12,000 megawatts of electricity, renewable energy being tabled. That's a massive, massive step towards fixing the energy insecurity. It's a massive step towards fixing the country. Regrettably, the president is tabling his National Economic Development Program in Parliament tomorrow. We've seen lots of commentary about what might be in there, but the truth is the details have not been published. We need to look at the details of what he's proposing. The rumors I've heard are that this is generally quite positive. The sort of key economists I speak to say they are expecting quite positive developments. What we've seen so far is good, but it comes down to the details, the deadlines, etc. tomorrow. To the extent that we are able to actually put pro-growth policies in place, fantastic. So very excited to see what our president puts out, proposes in Parliament tomorrow. And then the government has openly accepted from multiple sort of communications that it no longer has the capacity for infrastructure rollout. It does not have the financial capacity, and its expertise to actually develop infrastructure have also been hollowed out. And it acknowledges this. So from that perspective, there are reasons to be hopeful. The thing is, if I look at the road to nowhere, the prosecution of corruption has started. So corruption should slow down, not necessarily to the extent we need it to slow down. We haven't seen the high-level arrests as of yet. Bailouts continue. SAA bailout continues. The finance minister has said that he is going to talk about that in his medium-term budget speech, penciled in for the 21st, but I see he's trying to delay it by a week. So that, that bailout continues to worry us. We've seen other state-owned enterprises raise their hand for more bailouts again. Most recent was Denel a couple of days ago. The expenditure cuts that have been proposed by the finance ministry, so they said to us in June that we're going to cut expenditure. That looks reasonable. It actually looks achievable. We think he's going to get there. It's not a particularly challenging set of expenditure cuts. So from that perspective, we think that the government can actually rein in its finances to at least put us back on a sustainable path, not necessarily a good path. And the biggest challenge we've got is the policy disconnect. So you've got conflicting policies, conflicting statements from government, and that still needs to be cleaned up. And that's going to take time to actually deal with. However, in terms of bailout, getting ourselves to a bailout, the biggest concern we've got is the continuation of the propping up of state-owned enterprises. But what we also note is that the government has outright rejected a lot of the popular statements out there. They've rejected prescribed assets. They've rejected changing the Reserve Bank mandate. They've stated that they're not going to be nationalizing the Reserve Bank in the near term because, frankly, they'd rather spend the money elsewhere, which makes sense. So from that perspective, we take heart that a lot of the populist activities that could result in a failed state have been taken off the table. So at the moment, there's nothing out there that says, we're going to go down the failed state route. And the government's been very, very careful and deliberate in taking those populist statements off the table. That's not to say that in 5 years' time, things don't change. It's very easy to say that now when the decision isn't really upon you. However, the government communication at this stage is very much sort of concentrated around the other three quadrants. So where does that leave us with regard to asset allocation? It leaves us in the world where what we think is most prudent for the next 12 months is to earn your income in Africa and to look for your growth abroad. So our preferred asset classes are domestic bonds, domestic fixed income, and then global equity as well. Global equity we're showing as neutral on this slide because as people say, arguably it has run a lot. That being said, we do think there is significant upside, and we've tried to take a very conservative stance here, but it is our preferred asset class from a risk perspective. And then local equity, people also touch on. Our perspective is that we're incrementally more bullish, we're incrementally more positive than we have been in the past, but not enough to move it to a sort of positive overweight at this stage. So that sums up our asset allocation in a nutshell. And what I'm now going to do is talk about our fixed income views and then hand over to Peter, who can talk about our equity views and pull it all together for you. Before we do that, regrettably, we had a roadshow in February, and that was my last roadshow in person, actually. I remember, I think the last event was in Johannesburg, and I went around the country standing on the stage, and my job was to talk about our COVID views. At the time, I said that, look, we're looking through COVID. We think it'll blow over, probably not a big event. I got that one wrong. I got that one properly wrong. But as we sit here now, if I look back over the COVID period, your best course of action through the extreme volatility we saw was actually just to sit tight, because asset classes have recovered, and in all probability, you've come through it reasonably all right. As we sit here looking forward, that's the message on COVID as well, is it's going to remain volatile. We are going to see second waves, third waves potentially. We're going to see interesting politics around COVID. We're going to see talks of further shutdowns, but each wave seems to have less and less impact. That's certainly the experience in previous pandemics. And the other experience is that if you are able to take a view of looking through this, it might present you with one or two interesting buying opportunities. But it's not something that's going to completely derail the system at this stage. Coming across to the Rand, Neil had the slide up that said the Rand was at 15 last time I spoke to you. It's now at about 16.50, so it's obviously weakened through COVID. You can see in our chart here, the jagged line is effectively the Rand dollar over time. And you can see how it shot up to a record weak level of, I think it was about 19.10 at the height of the COVID crisis. Against that, Anchor applies a PPP, purchasing power parity model, and you can see how the PPP model over time is pretty much a flat line. The Rand shot way weaker than our model would suggest, and it's been recovering. We believe that the Rand is likely to continue the recovery trend. The policies that are coming out on the ground in South Africa are probably going to be Rand positive. Equally, we think that the dollar is probably going to find itself in a weaker spate for a period. So from that perspective, we remain of the view that the Rand probably recovers to sort of the high 15s and then bubbles around there for a while, in our view. Coming on to yields, most of my competitors, most people are going out in South Africa and saying South African real yields are attractive. And what they mean by that is if you take the yield on a South African government bond, 9.5%, minus inflation, which is maybe 3.2%, that leaves you with 6.3% as what you're earning above inflation. South African bonds are yielding CPI plus 6.3. If I look across the world, what we've done is charted for you what the real yield is across different countries, both or different emerging markets. Very interesting to note that of the established, mainstay emerging markets, South Africa is the cheapest. Our bonds are still the most attractive. We still think that will attract foreigners into our market. However, we've got to be cognizant that in the scenario where we move into a sort of, weaker environment, bumble along environment, bailouts environment, bonds could get a little bit cheaper, which is kind of us converging with the rest of Africa. That being said, Most of the cheapness is probably already done. We see bonds as attractive. We see them as fairly priced. And we do think that South Africa is where you want to invest for yield. So from that perspective, to sum up South African bonds, we think it is going to be volatile. We certainly think volatility is here for a while still. The yield is attractive. We think you've got to hold South African fixed income for yield. They work well in most of the scenarios I outlined above. So from earlier, so from that perspective, they're actually quite attractive, sort of man for all seasons. And we do think there's potential upside. Foreign participation is low, but as volatility globally and risk aversion globally subsides, we think that our bonds are probably going to find further support. So we're quite positive in South African bonds. Hopping across to global bonds, what you see is a chart here of the yield on the US 10-year bond, the jagged line, against Anchor's fair value for the US 10-year yield. And what you've seen through the COVID crisis is risk aversion. People sort of flocked into US interest rates, into US bonds, and that's pushed the bonds to very low yields, certainly versus our fair yield, which is closer to about 1%. US bonds, global bonds are yielding less than that at the moment. So we think that global bonds are expensive by virtue of the volatility we're seeing, by virtue of some of the uncertainties that are definitely still in the market. So from that perspective, we're saying be a little bit cautious on global bonds. But if you've got money offshore, and you're sitting in equities and you just want to take your foot off the gas, it's not a terrible place to be. I don't think you're going to see the risk of massive losses or massive surprises. More than anything else, it's an asset class that'll just bumble along for a period for you. So from that perspective, we think global yields are also going to be volatile, albeit in a slightly narrower range. The yields are very low, so that's saying you've got to accept that if you're investing in global fixed income, you're not going to earn much. It's a safe place for cash that you don't want to put into equities. And as Neil said, we've actually just launched the Anchor BCI Global Income Fund, which is looking to earn dollar interest income for clients who are already abroad, don't want to repatriate the money, but just want to take their foot off the gas on equities for the moment. To summarize the fixed income views, domestic income, where will the money be made? Buy domestic income for its yield. The 10-year bond, which is ranging between about 8.75 and 10% over time, means buy the bonds, be patient, accept you'll see some volatility, but you're going to see great interest income that you aren't going to earn anywhere else. Conversely, global fixed income, avoid duration and hold corporate bonds. We can generate for you between 2 and 3% yields. That should achieve your objectives of just taking risk off the table, and it's not a terrible place to be for clients who are slightly more risk averse offshore. With that, I'm just going to show the disclaimer so compliance knows I've shown it and say thank you very much. I appreciate your time, and I am going to hand over to Peter Armitage for the equities component.
Hi folks, it's a pleasure to have you all there. We continue in our Zoom mode. Right. You should be able to see the slide up there. I'm going to talk through SA and global equities, give you our key views. We put out a quarterly strategy document the beginning of every quarter, and we call that the Navigator. That went out a day or two ago. So for all of you who've got nothing to do on the weekend, print it out, or we can send you a copy. But it contains our views and some very interesting articles from across our business. So I'm going to talk together with three of our fund managers with the way we see the markets. I think the key message that we're sending out nowadays is you must become a global investment citizen. And the South African buy and hold strategy, which is kind of broken if you look over the last 5 years, it doesn't mean there aren't opportunities in sectors from time to time in South Africa, but we're increasingly increasing offshore exposure. And we're going to talk quite a bit about global equities. And that consumes a lot of our time and attention. From a shorter term perspective, we're projecting about an 11% return from SA equities over the next 12 months. So not terribly exciting, measured by what was achievable over the last 10 or 15 years. And there are some elements of the market. It's important to break down the market. There's some elements of the market that we think can give some quite nice returns. From a global perspective, we think the global economy is recovering. Nolan covered the whole coronavirus issue. We think it's becoming more about not what the coronavirus does, but the fear over the coronavirus. And I think people are just becoming accustomed to the fact that that it's part of our lives and are largely getting on with life. It'll probably take kind of midway through next year for the global economy to get back to normal levels. There'll be a lot of volatility. My son got caught in a super spreader event at Cape Town Varsity a few days ago, so he's got coronavirus, and certainly the fear of it is dramatically different. He's got no symptoms. 2 months ago, the whole family would have been in shock, but we're just kind of getting over with it and moving on. This is really the story of the markets in reaction to, and what's driven the markets in reaction to the coronavirus shock. And this is money supply in America. And this is really the stimulus, a graphical representation of the stimulus that happened. And you can see the fastest money supply growth on record. And that's what's brought the market back and brought the market back to levels where we think they're kind of reflecting the potential of shares. So I always like just to take a very simple graph of putting the markets in context. This is the MSCI World, so a world index. And you can see going back to January 2020, we had a massive dive, kind of a 35% drop. And then there's been a slow, steady increase back to kind of current levels. So if you'd gone to sleep in January and woken up now, you'd go, well, nothing's happened. But in the meantime, we've obviously been on a big roller coaster ride. The S&P is similar, but it's landed up a few percent in the positive equation. And I put 2 slides there, which are kind of bellwether non-tech type shares. So McDonald's, you can see a massive drop and is in fact higher than it was at the beginning of the year. So, you know, we as Neil indicated at the beginning, we started the year saying we were fairly cautious because valuations are quite high. And the valuations dived, but have got back to those levels. So while we're positive on global equities, we're talking 5% in dollars, which is below the long-term average. One has to gradually continue positioning oneself in global equities. But we think you have to work quite hard from a stock picking perspective in order to get, kind of double-digit returns. Something like Nike, the little graph on the right-hand side, that's now up 30% year to date. It's a company that's adapted well to the environment and is almost getting a bit of that tech flavor in terms of the way that they sell their product. So this is the most important slide, which we keep on showing and updating. So here's the S&P, which is up 5.6% year to date. But within that, the average share is kind of flat. So you've got healthcare, materials, all up 4 or 5%. Technology up 35%, and financials and energy down 20 to 50%. And that's really the global space that we've got to negotiate. We strongly believe over the next 10 years, the growth and the consistent compounding growth is going to come out of tech-related companies, but we've got to play off the valuation and make sure we're in the right shares at the right points in time. And Nick and Henry will go through more of that. We do see opportunities towards the bottom of the chart, and we're still able to buy selective shares at 10 or 20% off their were at the beginning of the year, and companies that we think can be, the same companies in 2021 that they were in 2019, but at a significant price discount. So in our global segregated portfolios and in our funds, like our equity fund in South Africa, we've got things like a JP Morgan, where we think trading at very attractive levels. The world market valuations, obviously with earnings going through the floor, the PE multiple is now looking like, close to kind of record highs. But I think it's important to look at this table. So what I've circled there is the forward PE of the market, current 1 and 2 years out. And you can see on that same line, the 45% earnings growth, which is really the recovery growth. And then you can see this is Bloomberg consensus. Analysts forecasting a fairly, decent year thereafter. And some of it on the basis that it'll, not all companies will recover their earnings in a 12-month period. So if this comes to pass, valuations then go back down to the kind of 16, 15 type level. On this chart, the average was just below 16. So the market is pricing in a pretty decent recovery. The way it's priced that in is to place a big premium on the technology sector. And you must remember that a lot of that is earnings driven. So a lot of the technology companies, their earnings prospects have been accelerated quite significantly. So they are much more valuable businesses than they were at the beginning of the year. We then get to the US election. For those of you, Peter Little, who is part of our strategy, helps run our managed fund, has done an excellent piece in our note that we sent out this morning and in our navigator on the US elections, and just looking at the different scenarios and how they can come about. I think the key message is if you get a blue sweep, and really it's all about that Senate column, we think Biden will probably land up being the president, although we're all quite nervous because we remember the shock that occurred last time, where the polls were kind of defied when reality came through. And the scenario of, if things stay as they are, it's more of the same. If you do get a blue sweep for the president, the Senate, and the House, you've then got two kind of inflicting forces. One, tax rates are probably going to go up, but on the other side of it, government spending will increase. And we think the one will offset the other. And the market is certainly starting to price that in. So in other words, we're not particularly concerned, and we don't think the election and the result will have a massive impact on the market. A Biden result could be a positive. What we are concerned about, however, not from a long-term point of view, but from a short-term volatility point of view, you're going to get the election on the 3rd of November, but there might, with all the mail-in polls and the like, we could well see the election results taking quite some time to be confirmed. And if Trump loses, one can expect some I guess, unexpected moves from him. So you could see some volatility. That is priced in. What we're showing here is the cost of protection. So you can buy the VIX index futures at certain dates, and you can see how the price of the volatility index by date kind of peaks at the election time and then comes down. So the market's expecting volatility. We don't think that changes the long-term value of assets. So our approach is, to have some cash at hand moving into this, and if this produces some pricing opportunities, to take advantage of that. The last time there was a disputed election in 2000, the market went down by 8%. So, that's the kind of volatility one can expect. So within that global market, you're seeing the tech sector move sharply. Here you can see the potential still e-commerce penetration, while it's been growing dramatically, is still quite low. There's a lot more growth. People like Morgan Stanley saying that online sales will go from 30% to 50% over the course of the next 5 to 10 years. So this is certainly where you want to be from an underlying growth perspective. Something that our tech team always points out is, we view online retail as simply a shop on a screen where you can go and click on a product. Whereas I think what one needs to understand is that the way that people behave is changing. So people are shopping in a different way. They're not going into a shop, they're going into Instagram. And this is an Instagram shop where you can have an experience and get sold the product, and it becomes a social commerce or immersive experience. And 63% of Americans use Instagram daily, and 60% of these are using new products and discovering them on the platform. And I think importantly, the long-term value of a digital customer is more than 4 times an average customer. So where we sit in the ever-changing world is social commerce, is in the traditional world, the Shopifys and the Amazons were selling the product and getting the logistics done and doing payment processing. We're now seeing Facebook enter the commerce world through what we call social commerce, where people are buying products on Facebook, and that has strong potential to increase ad spend and then take a take on the products. So that's the tech side of things. On the other side of things, as we explained, there's a lot of shares which are at lower prices than they were at the beginning of the year, where we think there is nice upside potential. So one of those that we've identified here, just to give an indication, is JP Morgan. And in the top right-hand side, I've put the share price graph, where you can see it's trading at values, kind of 30% below the beginning of the year. This table just shows the reserve buildup. So we think that'll peak. They obviously had to make big provisions for credit losses at the half year, and then increased from 25 to 34 billion. But this is not an all fall down situation like 2008, where the banks went into massive losses. JP Morgan will still be profitable this year. and you can buy a business with a 17% return on equity, now at 1.6 times book. So we think there's space for these type of shares as well in the portfolio. This chart just shows the quality of the loan balances out there compared to 2008, where the big issue was the subprime category. Banks have been a lot more conservative over the last 10 years and in pretty good shape. So from an equity perspective, our global high street equity, which is our flagship segregated portfolio, we run a lot of those portfolios for financial advisors, and that's delivering exactly what it says on the box. Since inception, 12% per annum in dollars against a market of 10.9, outperformed quite nicely over the last 12 months. And there it's a nice, fairly conservative balance with a growth focus across global equities. Nick Dennis is going to talk to you a little bit about the Anchor Global Equity Fund. I think Nick's having the absolute time of his life. He is somebody who's focusing on the kind of multi-bagger, big upside potential type shares in the world, and delivered a phenomenal 72% return over the course of the last 12 months. And Nick will tell you his thinking as we flow through. From an SA equity perspective, luckily Nolan's talked all about the SA economy and the different scenarios. I think in summary, we think resources look pretty attractive. Global infrastructure stimulus, both here and around the world, I think is going to pervade. And we've seen quite an interesting equation recently where the resource prices have moved upwards, but the share prices haven't followed suit. So we think there is another leg up in the resources space. For example, a company like Impala, if spot prices we put into its earnings now, you're talking about a 3 or 4 times PE multiple. Naspers, I think the market's completely exhausted with the whole discount argument. But we think they've made quite clear that they're taking steps to exercise that, but they need regulatory and other approvals. So I think people are almost not interested in that story, which probably means it is the point at which things turn a bit. To put it in context, Tencent has gone up 58% year to date. Naspers is only up 33%. And that's obviously that also doesn't, from a Rand currency perspective, it's lagged significantly. There are some opportunities in the Rand hedge space. They're not homogenous. One has to look at it company by company. So a projected 12 months return of 11.3%. 2 pictures, if you want the slide pack, we're very happy to send it to you. There's some detail here that I think is very important to understand. When we talk about the SA market, we've broken it down here into industries and profit drivers. And you can see the SA market is really a kind of financials, materials, and technology sector. So your 44% of the SA market is driven by the SA economy. Another 42%, importantly, it's not so much a global share portfolio as an emerging market share portfolio. So if you've got SA equity, you're effectively buying into emerging markets with an SA bias and a strong bent on commodities and technology. So one should supplement that with developed market equities as opposed to further emerging market equities. We've then taken a view, this is not a market return point of view, but a 5-year earnings growth. And ultimately, it's earnings growth over time that informs what happens to share prices. So we've taken those share categories, so financials, Naspers, etc. We've looked at what we think the bull and the bear case is from a 5-year perspective in terms of what they can grow their earnings by. I could talk about this for half an hour, but in summary, what I've circled on the right-hand side there is the bull case is earnings growth of 10% per annum on a weighted basis of the next 5 years. And a bear case is flat. The base case is kind of somewhere in between that with 6% earnings growth. But obviously within that, you're going to have the commodity companies rising dramatically and then having a cyclical low. Naspers is likely to give you pretty strong sustained earnings growth. And a lot of the SA Inc. type stuff, it's difficult to see with GDP after this year, probably running at 2 to 3% and then maybe even coming down from there, how they can sustain above average growth. So in summary, you will see some nice share price performances, and that's our job, is to identify and guide those along the way. But the buy and hold strategy from a South African market, which is 1% of the world, we don't think is the core philosophy right now. And one needs to increase that global exposure. In talking through Naspers, I think it's important when you look at the share just to understand the gravity of what's happened in the technology space. And this is 1990, 2000, 2010, 2020. 2010, Tencent was the number 18 company in the world. Today, it's the 6th biggest company in the world by market capitalization, and in fact reached a record high this morning. So we're talking about one of the top 10 businesses in the world that you're getting exposure to. I've then just done the old discount slide. I think we're just going to leave it at that, sitting at a 56% discount to its fair value. So we think over the course of the next 12 months, that discount, that it's really kind of, you could justify a 20 to 30% discount. I think that's where a lot of NAV type plays, as people view them around the world, are taking place. But I think our recent discussions with management lead us to have some confidence in the fact that they can do some things to narrow it. And you're coming from such a low base. So A, we like Tencent, despite the fact that it's run very hard. We think its prospects are excellent. And 2, you're buying in at a very low discount level. So we see some nice prospects for that. This is just, we talked about the resource side. This is just in the third quarter, what resource prices did. So particularly in the platinum group metals, you see 20 to 75% price increases, iron ore up 23%. And the market's kind of having a breather on the resource share prices, which we think creates an opportunity. So to sum up, my part of the presentation, we think the traditional big league asset managers who are managing huge equity bases have to defend the status quo. We think that SA, you should be opportunistic, focus more on offshore. We've shown you that the long-term growth in the base case is fairly unexciting, but there are opportunities within it. From a 12-month perspective, we've explained why we think there should be a reasonable return from SA equities. And from a global equity perspective, some very exciting growth stories out there. But we've shown you that, the high quality companies are back to levels above the beginning of the year. But there are some opportunities, particularly in the financial sector, in good businesses with good prospects that you can buy kind of at a 20% discount. So that covers my segment of it. We're now going to spend 5 or 10 minutes with Nick, Henry, and talk through their segments of the market. So Nick runs our global equity fund, which is on the Sanlam platform offshore, and locally you can buy it through the Global Equity Feeder Fund. Nick, your funds had an absolute dream time, kind of 50, 60, 70% returns, depending on how you look at it. How do we view, when something's done so well, it creates a little bit of nervousness. Perhaps just give us your thinking as to the future from here.
Okay, cool. Thanks for the introduction, Pete. I'm gonna talk you through. I think if we take a step back, I think it feels like quite a strange environment for a lot of people. Obviously with COVID, and then with everything that's happened since, and where markets are sitting, and so. Yeah, certainly, I don't think we're not in Kansas anymore, and I don't think we're going back to Kansas. So I think from my perspective, there's 2 major themes in the market that I'd like to talk about. The first one, I think, is my view is equities are quite expensive, particularly the good ones, but I think they're going to stay expensive, and they might become even more expensive than we've seen up until now. So some of the major factors at play are very low, ultra low interest rates, the rise of passive investments, so that's a totally value agnostic buyer. Asset scarcity, the amount of stocks, listed stocks has fallen over the past few decades. Highly supportive policy action, and all of this leads to the acronym TINA, which stands for There Is No Alternative. So what this chart is comparing is the PE ratio of the S&P 500, and it compares it with effectively the PE ratio on bonds, on the 10-year US bond. And this is just the inverse of the bond yield. So if the US 10-year is trading at 70 basis points, that's a roughly 130 times PE. So what I think is that there's going to be an upward drag on PE multiples. But it's not going to be spread evenly across the board. The rising tide is not going to lift all boats. So I think for companies that are high quality companies with some growth, doesn't even need to be high growth, it needs to be some positive real growth. I think those companies are going to see their multiples expand, as has been the case through COVID. And then I think there's going to be a whole cohort of companies that are sort of low quality, no growth or declining earnings, and the companies that are really at risk of secular disruption. I think they're going to get cheaper and cheaper, and they're going to stay cheap. And so I think what you've already seen this year and over the past few years is a real bifurcation in the market between the winners and the losers. And I think that trend is set to continue over the foreseeable future. I just would not bank on mean reversion. So that's the first idea. The second big idea is this idea of what I like to call it the second Cambrian explosion. So the first Cambrian explosion happened roughly 500 million years ago, and you had this explosion of new life forms created over call it a 20 million year period. I think, and that's kind of an analogy for where I think we are today. I think we're in an explosive period of new ideas, creativity, innovation, new business formation, and really that's been led by technology and enabled by tech. So just to give you some examples of these are actually funds, stocks held within the fund, and you've got these companies that are acting as platforms, and they are the building blocks for other businesses, small businesses, medium-sized businesses, and entrepreneurs to build and create on top of these platforms, and also software developers. So what you've got now is you've got a world where kind of like the Lego blocks, you're getting sort of enterprise quality, mega cap quality tools and products getting farmed out to individuals and small and medium businesses, and they can build on top of that. So it's just leading to a wave of like exciting new things. Now, if there's one word that really sums up what I'm looking for in the Anchor Global Equity Fund, it's multi-baggers. So it's companies that can grow 5x to 10x over the next 5 to 10 years. Now, what I'm trying to illustrate in this chart is that, typically the asset managers tend to use just the left side of the brain, very logical, very spreadsheet driven. But I think to play in this realm and to discover these opportunities, which are often rather unorthodox, you need to use the right side of your brain. It takes imagination, it takes creativity, it takes some thinking outside of the box and thinking, where could things be? And I would also think it takes like quite an optimistic view of the world. I don't think this is a place where pessimists will naturally succeed. So this shows just how the Anchor Global Equity Fund, this is the offshore fund, is done, up 54% this year versus the MSCI All Country Index, which is up 1.4%. And this is as of September. And then if we look at you can also access the fund through the local, the Global Equity Feeder Fund, and that's up 75%. So in Rand terms, you've got the difference there. So 75% versus 21% for the market in rands. So looking ahead, I still see just enormous opportunity in the kind of multi-bagger space, the innovative companies, these kind of platform companies that allow other companies, individuals, companies to build on top of and thrive. I think it's a really, really exciting time to be an investor and a stock picker. So things have done well, but I think we're in a very, very exciting time. So I remain bullish. And,
also, just to clarify, so yours is a global equity fund. What are you doing outside of the kind of tech space? What kind of companies are you supporting and buying?
So look, I mean, the vast majority, almost all of the companies are tech enabled in some way. So, I mean, just to highlight, this is not a tech fund, but it does. I think tech sort of touches is a key part of almost all of these businesses. So they're not all software, but there's e-commerce, there's software, there's payments, there's social, like a whole host of different different businesses with their own idiosyncratic drivers.
Yeah, fantastic, Nick. Thank you very much. We'll now hand over to Henry Biddlecombe. Henry's been with us for 5-6 years, developed a strong appetite and an analysis in the tech space. So we've got Nick's Global Equity Fund, which can invest right across the market. We have a local BCI, Anchor BCI Global Tech Fund, which is RAND denominated and accessible in SA. Henry is the co-fund manager of that, talks with a lot of passion, and we decided to give him a bit of time just to talk through, how he views the tech world. And Henry, obviously with a big focus again on, this up over 50% this year. Where do you see the opportunities and how do you approach that?
Thanks, Pete. Good morning, everyone. So there's no doubt that the proliferation and subsequent performance of technology companies across global equity markets has been one of the most prominent investment themes over the last decade. And a great way to illustrate that actually is to show you this graph, which shows you the relative performance of the NASDAQ, which of course is a tech-heavy index, relative to the S&P 500 over that period. And you can see that if you'd held the NASDAQ instead, you would have outperformed the S&P 500 by around 175%. Now, for any investor, that's life-changing money. But of course, the million-dollar question is, what will that relative performance look like over the next decade? And our view is that the trend you see on this chart will simply continue. And that's not a hunch. That's attributable to what we feel are clearly identifiable, very fundamental and very measurable driving forces in the tech space. And these are forces that we've spoken about with you before, so I'm not going to spend too much time on them today, but just to run through them quickly. It's the frankly astonishing research and development spend coming out of that space. It's the frankly superior economics that technology companies benefit from, and we call them network effects. And then it's the relentless pace of innovation coming out of that space as well, and that's something we'll explore a little bit later. If you guys are interested in a sort of more in-depth discussion around these driving forces, please go to our YouTube channel where you'll see a 12-minute video that we've put together that explores these driving forces. It's called The Tech Imperative, and it's there for you to watch. And it's also an interesting video to perhaps send to your clients if they're interested in the tech space or our fund. So I thought what I'd do is I'd spend a little bit of time together today exploring what I feel is probably a widely held misconception among many of our clients at this stage. And that is, if you were to present the technology story as a clock, most people feel that we've only got around 15 minutes left. Whereas we feel that the truth is we're only about 15 minutes in. And to explain why, I thought what we could do is we could just chat about some of the more interesting themes that we're invested in through our fund. And hopefully that'll give you an idea of why we feel there's still a long way to go here. Now, Pete kind of stole a little bit of my thunder with that e-commerce slide. And that for me is phenomenal. Given the tremendous success of Amazon over the last decade, e-commerce penetration is still only sitting at 21%. So there's still a long growth runway there. But things are starting to change. And I think social commerce is an interesting one. And we're exposed to that through Facebook. Pete's already told the story, but actually it was really funny the other day. He came to work wearing a really strange mask, which kind of made him look like he works on the International Space Station. And you just kind of knew without asking that that was a kind of a spontaneous Instagram late night purchase. And when I asked him, he confirmed that. So the Instagram's definitely changing the way we shop. But some of the other themes I think we can chat through quickly. The first is platform economics. Now, platform economics is an interesting phenomenon. And that's where a technology company really starts to benefit from its scale. In other words, as it becomes bigger, so it starts to grow more quickly. And a great example is a little company that was not a little company, it's a little share in our fund, a company in China called Meituan Jianping. The best way to describe it would be it's the Amazon of services in China. So it's your sort of everyday convenience app that you use to complete many tasks. Their major segments right now include food delivery, ride hailing, and the booking of flights and accommodation. But the beautiful thing about a company like that is they have a base of 450 million users. So to grow, all they need to do is add a new product or a new service, and immediately you've got 450 million new customers. Now, with a total addressable market of around 1 billion users in China, we think that that company's prospects are fairly exciting. The second trend I want to discuss is distance learning. Now, I'm sure a number of you follow what's happening in the tertiary education market in the States, and we feel that in its present state, it's basically unsustainable. So students are incurring a huge amount of debt in the region of $100,000 to $200,000 to obtain a fairly generic 4-year bachelor's qualification, and they're then entering a fairly tight labor market, and they're struggling to pay that debt down. So in effect, they're underemployed. And then there's Chegg, and it's an interesting business. And what they've done is they've come out with a series of highly focused, shorter format courses, which are between 6 and 18 months in length, and they cost between $30,000 and $50,000 to complete. But what's most interesting about the model is that you only need to pay for that qualification once you obtain gainful employment. So it's almost a no-risk solution for a prospective student. The model's gaining traction. They've got around 3.5 million subscribers in the States today, and that's growing at around 30% per annum. So that's a trend we're excited about. The third is audio or podcasting, and that's a trend that's become almost synonymous with one company, and that's Spotify. Now, a lot of you would know Spotify as a music streaming service, but they're starting to evolve into something more complex. They've introduced video, so now you're actually watching shows instead of just listening to music or podcasts. And they've also added a layer of interaction to those shows. So now the hosts of those podcasts can interact with their audiences through polls, and I'm sure there'll be other features coming through soon. But the point is they're starting to look more and more like a modern version of a TV network. Now that blows open an entirely new addressable market, which is the global advertising market. It's around $560 billion annually, and TV advertising makes up around 1/3 of that. So if Spotify can end up just taking a very small share of that market, we think that this is a share that can go up multiple times from here. And the last one is a trend that I call the direct-to-consumer trend, and that describes the way that conventional businesses are making use of technology to build direct relationships with their customers, where in the past they needed intermediaries. And I think Disney at the moment is such a great example of that. So, of course, in the past they needed to show their movies through cinemas. Now they've launched Disney Plus. It's a streaming service that I'm sure most of you have heard about by now, but it's not simply a streaming service. If you really zoom out and think about it, what Disney have done is they've established a monthly recurring transactional relationship with, as of today, 60 million Disney Plus subscribers. And we think that in 2 to 3 years' time, that number will be closer to 150 million subscribers. And the opportunity they have to bundle in other Disney products and other Disney services into that subscription service is mind-boggling, right? Think about this. If you're a family with kids, would you pay $30, $40, or $50 a month for Disney Plus, for discounted tickets to access their theme parks, for early access to their blockbusters, perhaps for personalized birthday shout-out messages from your kids' favorite Disney characters? We think that a bundle like that would hold a massive amount of appeal to consumers. And as the business starts to look more like a subscription service, we think that the market will start to attribute more value to it. And so we think that this is a share that can re-rate upwards quite a bit from here. The other thing that I want to chat through is the way that value creation in the technology space takes place. And that is, it takes place in a very non-linear fashion. To illustrate that, what I've done is I've produced this graph showing the value of 2 companies going all the way back to 1996. And the first is Procter & Gamble. It's the blue line. Now, that's a very typical blue chip company that a lot of your clients would have owned through time. They pay around 70% of their profits out as a dividend, and they retain the other 30%, and they earn a return of around 10% on that reinvested capital. And you can see how the market value of that company has progressed over time, where the value creation at least takes place in a linear fashion. By contrast, look at the orange line. That represents the market value of Amazon. Now, Amazon is a typical technology company that reinvests every single cent of its free cash flow back into growth and back into new initiatives. But what I want you to take note of is how, as the company becomes bigger, so the rate of value creation starts to accelerate. And that's so typical of the tech space. And the most phenomenal statistic for me is that today, as one of the world's largest companies with a market cap of, call it $1.7 trillion today, Amazon still created 50% of that value in just the last 2 years. And that's a phenomenon that we feel will continue through time. So that makes 2 points for me. One, it's important to maintain an allocation to the tech space for over a long period of time, because the value creation only comes through in later years. And the second point is you must stay the course for the same reason. Just to touch on the performance of the fund very briefly, it is a young fund. We only started it on June the 6th last year, but since then it's returned around 58% in rands. Around 18% of that is made up of rand weakness, so it's around a 40% dollar return. We're quite pleased with that. But what's more interesting to me is if you look at the makeup of that return. Now, what I've done is I've just tabulated the top 10 contributors to the fund's performance since inception. But I want you to have a look at some of the shares that have really contributed to the fund's performance. Companies like Spotify, Delivery Hero, Meituan, Junpei. I mean, Delivery Hero is up 200%, Meituan's up 150%, Spotify up 100% so far. These are shares that you won't gain exposure to by holding a passively managed product. So in other words, a product that tracks a technology index, because these companies aren't significant constituents of those indices. And that's why we feel that an active strategy in this space is far more appropriate. And then lastly, I just want to end off by going through what we're trying to achieve as an investment team and with our fund. And that is, we aim to meaningfully outperform global equity markets by taking relatively concentrated positions in high conviction ideas. Typically, our portfolio turnover will be low, and that's because we aim to hold positions over the long term. And typically, we won't initiate a position where there's less than around 50% upside to fair value. Thanks, guys.
Great, thanks, Henry. I'm now going to move on to Liam. So Liam Hector's been managing the our SA Equity Fund for many, many years together with myself, and also runs our Anchor Accelerator Hedge Fund, which I think is getting it just right in terms of a risk-return balance. That was last year the best long-short hedge fund in the country. And in the tumultuous times of this year, up about 15% at the end of August. I think Liam sits in London, which adds a very nice dimension to the investment management of our equities. And he also there, with all the management teams coming through London, gets a lot of exposure to emerging markets, and particularly in the Accelerator Hedge Fund, takes quite a lot of exposure, positive and negative, to other emerging markets where there's some fantastic opportunities. Liam, the key thing that we all scratching our heads about in South Africa is exposure to SA, exposure to other emerging markets. How does one balance that? Perhaps you could just talk through how you see the opportunities in other emerging markets and how you see that relative to SA.
Sure, thanks, Pete. Hi, everybody. I think to try and summarize what's the sort of dynamic that's been at play for South Africa relative to the rest of EM, where it sort of fits in the world. At the risk of oversimplifying it into one slide, where obviously there are a lot of nuances at play, but I guess the easiest way to summarize it is in the space of a short space of time on one slide would be to just show the sort of different growth dynamics and the way that South Africa's participation has changed over the last, coming out of isolation into sort of integrating into the rest of the world. What's become clear, right, is that the growth rates, as the growth rates tapered off in South Africa, and the emerging world's growth rates accelerated, largely as a result of sort of emerging China and sort of the way that the sort of financial inclusion has changed across EM as they've become a bigger part of the global pie. South Africa's kind of been left behind, and unfortunately, the result of which ends up with a far lower sort of participation rate in emerging markets. It becomes it becomes a less relevant place in a sort of investment universe where there's a additional complexity, especially for Western investors, to analyze, to make investment decisions, to DD companies. A lot of the investment resources and analytical resources then start shifting towards focusing on particularly the East. So I wouldn't say that South Africa, the chart on the left-hand side, is just purely a South African story. I think that there are quite a few emerging markets that probably have experienced quite a similar dynamic. But what you've found is that unfortunately South Africa's relevance has waned, and even those stats are flattered by the fact that you've got a company like Naspers which struck it lucky in China and is propping up that number, probably close to a third of the just over 4% that it was at the end of last year. So I guess to demonstrate quite simply why this has happened, you can see on the right-hand side there the differential in growth between the two places, and I guess it goes down to the reason of why you want to invest in emerging markets in the first place. It's an asset class or geographic makeup that's higher risk, and you expect to achieve a higher return on your money, higher return on equity, and ultimately more growth out of those places, driven by sort of the more favorable demographic tailwinds. And what we've sort of found, especially over the last 5 years, where, on our numbers in South Africa, the sort of typically domestically focused industrial and consumer-facing businesses had their return on equities peak somewhere between 2012 and 2015 on most of the companies under our coverage list. What was happening was we were sort of getting forced into ideas that we perhaps wouldn't have executed in South Africa, and we would have sort of led us to start looking beyond our borders, trying to apply the same principles that we applied in South Africa, but still with a very focused geographical makeup. We didn't want to expand the sort of typical South African investment process just broadly across the world. We wanted to try and keep sort of focused on certain geographies that we could try and take advantage of quite interesting demographics that were playing out. So what we did was, particularly in the Accelerator Hedge Fund, was we expanded our investment opportunity set to beyond South Africa, and by definition, the fact that it's a hedge fund means that you can take advantage of opportunities both long and short. And I guess we're finding that there was more growth beyond the borders, similar inefficiencies in the market, which is something that we've enjoyed about the South African market, and it's the reason why we still continue to be very active and sort of focused on South Africa, and ultimately just expanded our opportunity set and eliminated a lot of the mistakes that I think we would have made had we tried to sort of force ideas in South Africa. We were able to create a sort of core portfolio of stocks that really fitted what we were trying to achieve in terms of bottom-up drivers, and a lot of that sort of core portfolio, the low turnover, the kind of stuff that you want to anchor the portfolio in, was starting to be sort of constructed in geographies outside of South Africa, but yet within emerging markets. So I guess it begs the question of why keep any exposure to South Africa. I mean, a large part of the beginning part of this presentation was sort of highlighting the risks and the potential opportunities if a whole number of factors play out in a certain way. But for us, our strategy, particularly in the hedge fund, is less reliant on a market beta, or the market's necessarily just trending upwards. We found that over time, looking at our attribution, we're still able to generate positive alpha and positive absolute returns in South Africa. We still think that the market is one where there are great opportunities for sort of active stock selection, both long and short. In fact, at the moment, we're finding in South Africa one of the more challenging things is on the short side. So, that's probably a bit of a signal to suggest that the South African equity market at least has plateaued for now, and with particular reference to the domestic equity market. The more cyclical South African businesses. But I guess we started in this industry at Anchor. We've had a passion for finding stocks, for finding opportunities, and I guess particularly in the local process, we were finding the team was getting quite frustrated with the lack of investment opportunities that got us excited, that got us sort of passionate or reminded us about why we joined this industry in the first place. And the refreshing thing is knowing that you can apply the same sort of principles to other emerging markets and generate or at least experience the same kind of outcomes that we experienced in sort of the lead up to the 2015 peaking of return on equity and investment opportunities within South Africa. I don't think that the argument of the South African local market being diverse enough or there's enough rand hedge exposure on there is justification enough for us wanting to necessarily bundle ourselves in South Africa. I don't think that holds true. I think that there's enough foreign currency exposure in South Africa as a percentage of the index, but quite concentrated into a very niche or very small opportunity set. So I definitely think where you have the ability to apply similar principles, investment principles to other markets, one should feel compelled to do so. But yeah, I guess the opportunity set for us has been interesting. It's been challenging, and it's one that's continuously evolving. And we're excited with the results so far. I guess it's on the chart that you're seeing on the screen there. It's been a grind, and ultimately that's what the strategy is there for. It's not there to take advantage of market beta. It's there to sort of try and concentrate your stock selection and extract alpha out of that.
Great, thanks, Liam. I think what the chart on the screen shows is proper returns, 15% plus per year with low volatility. So that's obviously what we're aiming to do. So I just want to sum things up. I think what you've heard from Nolan, Liam, Henry, Nick, myself is where will the money be made? In domestic equities, I think we're making it quite clear that from a long-term perspective, the buy and hold strategy is troublesome. We think it's incrementally more attractive, but it's got risk. There are opportunities, and I think we've illustrated how we want to play that. From a domestic fixed income perspective, looked at from a global risk return perspective, yields of 8.75 to 10%. Buying bonds and just being patient, we think is a winning strategy. From a global equities perspective, we've given you different perspectives on different parts of the market. Stock picking is obviously very important when the market has got fairly expensive, but we think there are still some opportunities. We are sitting with a bit of cash in the sidelines in our segregated portfolios. And then in global fixed income, to avoid duration, and obviously there's not much of a return to be held. Corporate bonds for 2% to 3% yields. So that's how we're viewing the investment world. So I'll stop sharing now and move it over to question time.
Thank you, Peter. I've collated a couple of questions, and I've got a couple of specific questions that I'd like to address. So let's dive in. I'm going to pick a nice easy one to start with, which is when will your funds be available on Glacier? Well, our funds are available on Glacier. In fact, our funds are available on most platforms. We have a fund availability document, which I will circulate post this meeting as well, which sets out which funds are available where. It is a constant struggle. The platforms are varying degrees of open for business. And all that I'd like to say is if you do have a need on a platform that hasn't been filled yet, please let us know and let me specifically know. A large part of getting the funds available on platforms, if they're not there yet, is demand from you guys. So if you can help me with that, I can certainly help you with that. Then to dive into the questions, we've got one here from Garth asking whether, and I think Nolan, perhaps this one's for you. Can you please discuss the performance of the bank's preference shares year to date and factors driving their valuations?
Hi, partially I can answer that. I might ask some of the equity guys to weigh in as well. The driver of bank preference shares is generally they pay a dividend stream, which is a percentage of prime. So the first aspect to be aware of is that obviously 3% interest rate cuts from the SA Reserve Bank equals 3% cut in prime rates equals a far lower dividend stream. So you would expect that takes some value off the preference share. Your dividends have reduced quite dramatically. Second aspect of it is that the South African Reserve Bank put out a circular to banks, which basically said to them, you're not allowed to pay bonuses and you're not allowed to pay ordinary dividends. Preference shares weren't caught up in the circular. However, there's been a lot of speculation as to whether or not dividends will be paid. And there's a risk premium associated with that. So that's also acted as a bit of a handbrake for preference share prices. And then, so those are the negatives that have held the preference shares back, that have seen the preference shares come under pressure. Conversely, what you do see is two things. You see that the preference shares are an expensive form of capital for the banks because the bank regulatory treatment has changed. And as such, there's a constant speculation in the market. Will the bank buy these preference shares back? I think Investex busy with a program to buy some of the shares back. So that does prop up the value a little bit. So it's a triangulation of those factors. But by and large, it's an illiquid market, so you'd expect it to be quite volatile. And unfortunately, the dynamics haven't been great this year. Actually, Liam, I don't know, you're closer to the banks. If you want to add anything to that, I see you shaking your head.
No, I think you've touched on it. I think the cost of capital for the banks means that there's probably a bit of an underpin there.
Cool, thank you, guys. Then, Nick, I've got a couple for you. I'm going to rattle them off. Some of them are related. Firstly, if global PEs will normalize over the next 24 months, will share prices track sideways until earnings catch up? That's the first one. Nick, could you please elaborate on why you expect the PE bifurcation to continue into the foreseeable future? And then the last one, what is the current demographic with respect to developing versus emerging within your global equity fund?
Okay, yeah. So why? So this is just a thesis. It's not a subject sort of open to changing my view. But so I think it's particularly the very, very low interest rates. Like once you go to effectively zero, there's no attractive alternative to. If I'm a huge pension fund in the US, and my obligations mean that I need to earn say 7 or 8% return per year, I cannot get that. It's very, very difficult to get that with investing in US long bonds at 70 bips, whereas maybe 20 years ago I could get 6 or 7% just very, very low risk and just have it in treasuries. So they can't just sit on cash. Like the institutions like that, they have to invest. And if you're in Japan, it's worse, and if you're in Europe, it's worse. So you have to increase your risk allocation. Like literally, there's no alternative. And the same is true if if you're an individual. So those are the big things. I think passive is huge. I don't know what passive share of the market is in the US. A number between 20 and 40%, say. But I think what's particularly interesting is with older demographics, it's much lower, and with younger demographics, they're virtually all passive, so like 90% passive. So as sort of younger demographics become a bigger and bigger part of the market, and as they put more money to work, that money is increasingly price insensitive. A passive index doesn't care about valuations. It's just a buyer. So that is likely to have an upward bias on PE multiples. So those are the big ones. And then I'll come back to this asset shortage idea. There's a shortage of really high quality growing assets in the world, and so you would expect those to be bid up. So I don't see those structural forces going away. Like what world would, I don't know. I need to think about that. Like, I have been thinking about it, and I'm not sure what would reverse those trends. So I think things are going to be expensive. I think there's a big risk of not taking enough risk long term for a lot of investors, and just sitting on the sidelines in cash, and just like I think that's going to be frustrating. I think Peter answered the first question in terms of like the normalization of PE multiples and earnings, that the market is, so it really has priced in a recovery next year. The market level, I'm not sure. I think it would. My guess is that it implies maybe a 7 or 8% return per year from here on out, but I could be wrong.
Yeah, I think if you do the maths and do the traditional spreadsheets that we've always done, it turns out a kind of high single-digit return. But what we know is it's never that. It's either a lot less than that, a lot more than that. And I think we're at a time where, we always do these 12-month projections because we've got to, kind of put our view on the table. But the market is changing very quickly. We've got to remain nimble and be prepared to change that view along the way, with the focus of always being invested in good growing companies where we don't think they're overvalued.
And then Neil, that final question. So within the Global Equity Fund, so 25% of the counters have headquarters in. Oh, sorry. Let me just put myself outside. Okay, no, that's gone. Yeah, the joys of Zoom calls. So 25% of the fund is headquartered in emerging markets. 75% is headquartered in developed markets. But on a look-through basis, the emerging market exposure would be quite a bit higher than that, because a lot of the US domiciled companies or European domiciled companies have a big chunk of their revenues in emerging markets. So it would be a lot higher than that.
Great, thank you. Then there's a question here from Anton. When do you expect inflation in SA to start picking up? Also, when do you expect the Reserve Bank to start increasing rates? The implications on the short end of the curve going forward, and your positioning regarding this. I guess that's a Nolan question.
I've unmuted myself already as you started reading the question. Hi there, Anton. Okay, many different questions all boiled into one there. Inflation expectations firstly. The two factors we look at is firstly South Africa's policy mix. And the point I would make is that the Reserve Bank is following an incredibly orthodox policy strategy. Similarly, when I look at what the finance minister is doing in order to manage a budget, it's very, very orthodox, very Keynesian. So in that context, what you've got is a policy framework that is likely to see inflation come down, not up. So that should keep inflation in check, and the concerns of a 10% inflation rate are pretty much off the table. Within the economic environment, then, we've got a situation where South Africa's economy is stuck in the mud. Consumers, 2.2 million people lost their jobs through COVID. That's going to see demand come down dramatically. You can actually see it. The biggest impact that we've seen through COVID is that South Africa's imports have dropped off a cliff. Vastly reduced imports, and that's a function of consumer spending, for example. So all of that combines to say that inflation is likely to be lower for longer. Unfortunately, inflation will push up in certain areas. Food price inflation probably going to be a bit higher. We also expect, your bad inflation, your inefficiency inflation, call it electricity tariffs, to potentially push up a bit. It's probably going to all equate to inflation bumbling around somewhere between 3 and 4.5% over the next while. We don't see inflation pressure. What does that mean for interest rate hikes? The Reserve Bank has taken interest rates to record lows. We think that this is probably as low as they go. And our base case scenario at this stage is basically flat interest rates, unchanged interest rates for at least the next 18 months, if not 2 years, and thereafter rates push up. What does that mean for the front end of the curve? It means that where I'm buying an R186 bond yielding 7%, just over 7%, my alternative is the repo rate yielding 3%. There's an incredible amount of value in short-dated bonds still, and we've actually been accumulating them over the last week. Actually, we bought quite a few into our portfolios because we continue to see good value in those bonds.
Thank you, Nolan. We are at the end of our time period, so I'm going to take one more question, and then we'll end off. For those of you that do need to leave us already, thank you very much for joining. We'll take the last question now from David. Great presentation. Thank you. Well, thank you, David. A question around SA bonds, search for yield in the USD ZAR movement. After the GFC, the rand strengthened significantly due to a search for yield. With a lot of foreigners having sold SA bonds and equity already, how strong can the rand get in a bullish environment if they return? And we see a repeat of 2003 to 2007, poor global returns, strong rand and strong SA market. What probability do you assign to this? Peter.
So I think that goes back a little bit to Nolan's scenarios. So you're talking about the high road combined with global factors adding some extra impetus. So that extreme view or that extremist sequence of events is I wouldn't assign a huge probability to, but it's we are sitting with quite a lot of risk and bad news priced into our real bond yields and our currency, if you go back to Nolan's currency slide. So some right moves and, there is a global search for yield, which isn't quite falling for the South African yield story. So if we were able to change the confidence levels and they went, hell, that's where you get the yield, I think you can see there is a scenario where that becomes quite positive. I don't think it's our base case scenario, but it's, I think what we talked about is the value that sits in those instruments or asset classes. Nolan?
Peter, I think you've summed it up pretty well. I would bear in mind that the rand dollar is a function of both, dollar strength, dollar weakness, and rand strength, rand weakness. It seems and feels like we're probably headed towards a period where the dollar is going to come, off the boil a bit. It's going to be a little bit less strong. So we may actually see a bit of rand support from that side, more from global factors than from domestic factors. But I'd agree with what Peter's saying is, the perfect Goldilocks scenario, it's unlikely, unlikely. And a more normalized scenario is that, global volatility still is quite high. And as that comes down, as volatility subsides, the price of options and hedge strategies becomes cheaper. We think that your carry trade will come to the fore a little bit more. There is further scope for rand recovery, definitely, but we don't think it's immense. We think, mid 15s, we'd probably start to take some client money offshore again in reasonable volumes.
Wonderful. Thank you, gentlemen. So just a thank you to my fellow panelists and colleagues and to all of you for joining us today. I really appreciate you sort of dedicating and giving us your time. I hope that you found today interesting and informative and that we've given you insight that will be useful to both you and your clients. And please, if you have any anchor-related questions or anything that we can help you with, please don't hesitate to give us to contact us and give us a shout. Have a wonderful day and thank you very much.